Welcome to this class on volatility trading featuring IVRQ, which is the implied volatility regime quantifier. This is more than just an indicator. It's a fully developed quantitative framework for reading and reacting to market volatility in real time. Whether you are trading intraday moves or managing expiry setups, IVRQ gives you an edge grounded in regime theory and quantitative modeling. I have created it with my own observations, and IVRQ bridges the gap between academic volatility metrics and live market application. With IVRQ, complex volatility data is distilled into clear, actionable signals, helping traders avoid noise and act decisively. This presentation will walk you through the core concepts behind IV, the architecture of IVRQ, and exactly how to use it for expiry day precision. Let's begin. Now, what is implied volatility or IV? We know it is one of the most crucial metrics in options trading. It's a forward-looking estimate of how much the market expects an asset to move in a year, expressed in percentage terms. But it's important to emphasize, IV tells us about the magnitude of the expected movement, not the direction. So a stock with 60% IV could explode upwards or collapse downwards. What IV tells you is simply that a big move is likely. It does not make any comment on the direction. This distinction is critical. High IV suggests a market anticipating major events like an earnings report, a central bank decision, geopolitical tension, anything that injects uncertainty. Low IV suggests the opposite, stability and low expected movement. Traders leverage this knowledge to inform their choices, either selling options in high IV regimes to collect premiums or buying options in low IV regimes where the cost is lower. So mastering IV is about timing, not prediction. You are not betting on up or down. You are assessing how big the move will be. It's like knowing a storm is coming without knowing which direction it will blow. In this presentation, we will explore how the IVRQ indicator takes this concept further and offers real-time edge, especially on volatile expiry days. Now, what drives IV? Implied volatility doesn't arise in a vacuum. It reacts dynamically to both predictable and unpredictable influences. Scheduled economic events like earnings release, Federal Reserve or RBI announcement, national budgets, they often inject volatility into markets. Traders anticipate sharp moves around these events, which drives IV upward. Now, it's not just planned events only. Sudden geopolitical tensions, market panics, or black swan events like the COVID-19 pandemic rapidly elevate uncertainty and fear. This emotional aspect of market psychology feeds directly into IV. Elevated uncertainty equals higher risk premium, which in turn means costlier options. Moreover, demand dynamics within the options market itself play a very big role. When traders start heavily buying options, particularly at the money options, it signals expectations of large moves. This demand inflates IV. Conversely, low trading volumes and complacency can suppress it. Understanding what drives IV allows traders to anticipate pricing shifts and fine-tune their strategy accordingly. Now, the relation between IV and option pricing is foundational in options trading, whatever options you trade. When IV is high, option premiums inflate because the market anticipates larger price swings. This benefits sellers as they can collect substantial premium for taking on the risk of volatility. In contrast, low IV regimes offer cheaper options. Buyers entering positions in such environments are betting on unexpected volatility arising later. If the volatility does materialize, the options gain value rapidly due to the embedded leverage in the price movement. So a rise in IV often signifies increasing market demand for options. Traders hedging positions or speculating on big moves can also push up IV. On the flip side, when IV falls, it's often accompanied by time decay, options losing value each day as expiration nears without any significant move on the underlying. These dynamics are essential to exploit whether one is buying straddles or selling iron flies or selling strangles. I mean, whatever strategy you are doing, this view on IV should be absolutely clear. Now, why does IV matter? Why it should matter for me? Because it offers foresight. Unlike realized volatility, which is retrospective, IV provides a lens into what the market anticipates. This predictive quality is invaluable. Traders can prepare for market movement, hedge appropriately, or capture opportunity, all before prices shift. In practice, IV directly informs what strategy you should use. When IV is low, options are cheaper. Buying strategies like long calls, put or straddles become more attractive. This is simple. When IV is high, selling straddles, iron condors, covered calls or naked puts are more favorable due to elevated premiums. On high stakes expiry days, IV becomes even more potent. It helps traders identify if there's still juice left in the premium or it's time to collect decay. Using IV intelligently isn't about complexity. It's about clarity and timing. When to act and how aggressively. That's the edge. Now let us understand the fundamental difference between IV and stock price data. It will be very clear in the next few moments why we are doing this. This distinction is crucial for anyone involved in quantitative finance, options trading, or market analysis. Unlike stock prices, which represent historical transactions and reflect supply-demand forces, implied volatility is derived from options pricing and captures the market's consensus on future volatility. Understanding this difference is vital when applying analytical tools. In the slides ahead, we will delve into how the structural properties of IV differ from those of stock prices and why technical indicators that work on price data will fail on IV and how quantitative modeling strategies need to adjust accordingly. At the core of understanding market behavior lies the difference between stock price and implied volatility. Stock prices are straightforward. They are derived directly from market transactions, reflecting the latest agreement or consensus between buyers and sellers, right? Implied volatility, on the other hand, is not a market traded asset. It's extracted from option pricing models such as the Black-Scholes-Merton model. That is what we are going to use. It reflects what the market expects volatility to be in the future, essentially capturing sentiment and anticipated risk. This fundamental distinction between what has happened, price, and what is about to happen, which is IV, drives much of the analysis and strategy in derivative markets. This slide explores the inherent characteristics and the calculation mechanisms behind stock price and IV. Stock prices are straightforward in that they reflect real transactions. They are path dependent and influenced by the sequence of trades and events. Implied volatility, however, is fundamentally different. It cannot be observed directly but is derived using pricing models such as Black-Scholes-Merton, which we call BSM for short. It's a calculated metric representing market expectations about future volatility and risk. These divergent foundations mean that price and IV behave differently under the same market conditions, and understanding this is key when to apply what analytical tool. Measurement units and determining factors play a crucial role in distinguishing stock price from implied volatility. Stock price is dominated in monetary units like dollars and rupees and is a direct outcome of trade interactions and macroeconomic influences. Implied volatility, in contrast, is a statistical estimate expressed in percentage terms, typically annualized standard deviation. It encapsulates expected market fluctuation and is shaped by derivatives demand, volatility skew, and uncertainty shocks. These fundamental differences in measurement and influencing factors underscore why modeling and strategy must be adapted specifically for IV versus price. One of the most critical behavioral differences lies in the continuity and mean reversion tendencies. Stock prices generally change incrementally unless interrupted by major news or external shocks leading to occasional gaps. In contrast, IV exhibits sudden jumps. These often occur around events like earning announcements, macroeconomic data release, or by a re-evaluation of future uncertainty. Moreover, IV displays a strong tendency to mean revert, gravitating back to historical average after spikes. This predictable reversion behavior is in stark contrast to stock price behavior, which lacks strong mean reverting traits and is often directional or random walk-like. Many traders and analysts rely on technical indicators like RSI, MACD, and Bollinger Bands. Nothing wrong with that. These tools are built on the premise that price exhibits trends, momentum, and sometimes reversals. So, technical indicators have been devised to basically analyze price. However, implied volatility behaves fundamentally differently. It is not a price series, but a reflection of expected future volatility. Its strong mean reverting tendencies, jump behavior, and complex surface structure make it poorly suited for univariate technical analysis. Furthermore, technical indicators ignore the surface dynamics of IV across strikes and maturities, compressing valuable information into a single, often misleading line, and you are running your technical indicators on that particular line. This makes technical indicators largely ineffective for analyzing IV trends or forecasting volatility regimes. Now, when analyzing stock price data, one is effectively working with a historical series of executed trades shaped by actual buying and selling pressures. This makes it fertile ground for pattern recognition and trend analysis, that is on stock price data. In contrast, implied volatility is not derived from transactions but expectations. It encapsulates a forecast, how volatile the market believes an asset will be in the future. These forecasts are influenced by psychological biases, demand-supply imbalances in the options market, and anticipated events. Thus, applying tools developed for historical patterns, that is technical indicators like RSI, MACD, whatever, on an expectation-driven metric like IV often produces misleading or noisy signals or extremely wrong signals. Unlike stock prices, which can be plotted as a single time series, implied volatility spans across two dimensions, strike price and time to maturity. This creates a complex volatility surface that evolves dynamically. Simplifying this surface into a single line or average IV figure loses crucial information, such as Q, which is the difference between IV across strikes, and term structure, which is the difference of IV on the same strike across maturities. Many analytical mistakes arise from treating IV as if it were a univariate series like stock price. So to truly understand IV behavior, one must engage with the surface characteristics and model it using tools that account for this complexity. Technical indicators are not designed for this task. So if you are using technical indicators on IV, kindly stop. So understanding the predictability structure of market data is key to successful modeling and forecasting. Stock price data is known as displaying identifiable patterns such as momentum, trend formation, reversal tendencies, which serve as a basis for many technical strategies. In contrast, IV behaves differently. It follows a jump, mean, revert, and a decay structure, often modeled using stochastic differential equations like the Ornstein-Uhlenbeck process. This foundational difference explains why tools designed for price data, which assume momentum or oscillation, often misfire when applied to IV. So the key is to use stochastic and regime switching models for IV analysis, which comes from quantitative finance. Now, price behavior is often form recognizable patterns due to the collective behavior of the market participants, right? Trader psychology contributes to phenomena like support and resistance, breakout formation, and momentum continuation. These recurring behavioral patterns make technical indicators useful on price charts. Implied volatility, however, is not a product of such crowd-driven interaction. Its shifts are primarily event-driven, arising from anticipation of news, earnings, or macroeconomic events. So spikes in IV are often sharp and short-lived, linked to specific catalysts rather than ongoing market sentiment. Because these spikes are not based on repeating human behavior or historical anchors, they do not lend themselves well to classical pattern recognition. This makes IV fundamentally resistant to tools that depend on recurring patterns, which is technical indicators. So statistical analysis reveals further distinctions between stock price and IV behavior. Return series from price data are well known for their fat tails, persistent autocorrelation, and volatility clustering, characteristics that make them somewhat predictable and trend sensitive. IV, however, operates on a different statistical plane. After transformation, IV series are often stationary, strongly autocorrelated, and exhibit sudden spikes. These spikes are not followed by continuation, but rather reversion, giving a series a non-trending profile. To put it simply, if a stock makes a sudden 6% move, it's a breakout, it's probably a continuation on that direction. Whole technical indicators are based on that, right? But IV, when there's a spike, we try to sell because we know IV will mean revert. So this fundamental difference means whatever technical indicators you are applying on price to catch a breakout and ride it will never work or make you loss if you apply the same logic on IV. These traits violate core assumptions, the traits of IV, of many technical tools that expect cyclical or trending behavior. So analysts must switch from signal-based approaches to statistical modeling tailored to high noise, low signal environments typical of IV. To analyze and forecast implied volatility effectively, one must abandon traditional TA tools in favor of robust quantitative framework. Unlike stock prices, IB behaves in ways that are well suited to stochastic modeling and probabilistic inference. Approaches like Ornstein-Uhlenbeck processes capture the mean reverting nature of IB. So regime switching models can identify volatility shift, while 𝐷𝐻 family models handle persistence and various clustering in transformed series. Moreover, since IB is a surface across strikes and maturities, models must be cross-sectional and sensitive to structural shifts, including event-driven volatility shocks. So if you use a RSI on stock price, it will be a totally misleading signal. Now, just give me a second. Okay, this is a summary which brings together central difference between stock price and IV. Stock price reflects completed transactions shaped by crowd behavior and economic data. It's historical and subject to trending or oscillating patterns. So far we have understood this. In contrast, IV is forward-looking, derived from models rather than trades. It exhibits mean reversion and sudden jumps, often with no continuation pattern. These traits make it incompatible with trend-following indicators. Ultimately, understanding these differences is critical to applying the correct analytical tools. Treating IV as if it were price can lead to faulty signals and flawed forecasts. So precision in modeling starts with recognizing these structural differences. So what is the conclusion from this? Conclusion is stock price and implied volatility are both vital financial metrics. They serve their distinctive roles and operate under different mechanics. Stock price tells us what has happened. IV tells us what might happen. This fundamental difference means we must be cautious while borrowing tools from one domain to use in another. TA, effective for price trends, often yields false signals when applied to IV due to stochastic, spiky and mean reverting nature. So the future of IV modeling lies in sophisticated probabilistic tools, statistical surface and regime-based frameworks. Acknowledging these needs will prevent analytical errors and improve strategic forecasting. Now we get down to the 𝐕RQ. This is more than an indicator. It's a fully developed quantitative framework for reading and reacting to market volatility in real time. So whether you are trading intraday moves or managing expiry setups, it will give you a very good idea. We have already done this. This is a specialized tool designed to bring clarity and precision to intraday and expiry day trading. At its core, 𝐈𝐕RQ calculates the real-time at-the-money implied volatility. But it doesn't stop there. It employs sophisticated smoothing algorithms to ensure readings are not overtly noisy, which is critical for actionable insights. One of the most powerful features of 𝐈𝐕RQ is its regime classification. We spoke about regime classification when we were trying to understand what is quantitative modeling, which must be applied on IVs rather than on price, right? So by dividing volatility into low, normal and high regimes, traders can immediately grasp the prevailing market mood. These are not arbitrary. Each regime implies a different strategy, a different risk profile and a different trading posture. Further enhancing its utility, 𝐈𝐕RQ incorporates color-coded slopes. Green for rising volatility, red for falling. Simple. These visual cues quickly communicate whether IV is in an expanding or a compressing mode, enabling traders or you to act faster. Altogether, 𝐈𝐕RQ isn't just a data point. It's a live decision support system for managing trades with edge. Visually, if you try to break down the visual layout, you will understand how it is a key to leverage the full potential. At the core is a dynamic IV line, color-coded green or red, on whether IV is trending upward or downward, that is IV is expanding or compressing. This immediate visual feedback tells traders where volatility is expanding or contracting. Next, triangle symbols appear at statistically extreme readings. These are pivotal. They can signal turning points in volatility regimes or areas of caution for contrarian strategies. Being able to spot this in real time is a major tactical edge. Now comes the background color of the chart, which denotes the IV regime, whether we are in a low, normal or high vol environment. If the background is red, we are in a high vol environment. If the background is green, we are in a low vol environment. If there is no color, we are in a normal vol environment. This classification shapes everything from trade structure to sizing. Finally, an information table at the base provides essential context like ATM strike, corresponding IV and days to expiry. With all the elements combined, 𝐈𝐕RQ becomes a cockpit dashboard for tactical volatility trading. How to use 𝐈𝐕RQ on an expiry day? Expiry day trading is high stakes and high opportunity. All of us know this. And 𝐈𝐕RQ is uniquely suited to this environment. The first tactic involves recognizing high morning IV. This is a standard observation which we have seen on expiry days, high morning IV. This often represents overstated risk that fades quickly. In such moments, short premium strategies like iron flies or spreads or calendar spreads can yield high reward with controlled risk. Next, watch for IV spikes throughout the day. These are often precursors to sharp directional moves. If you are seeing sudden upward IV momentum on IVRQ slope, it could mean a breakout is brewing. Traders can align with this volatility by shifting toward directional spread plays like long straddles or a directional naked option, or even a bull or a bear spread. As the day progresses and IV begins to fall, time decay becomes dominant. This is the sweet spot for neutral strategies that profit from erosion like iron condos, butterflies, naked straddles, etc. IVRQ gives you the context, timing, and confirmation needed to execute these strategies with precision. It's expiry edge distilled into visual form. Advanced users of IVRQ, as you begin to use this, stick with it for a few months, you will understand that regime shifts are where the real edge lies. When the indicator transitions from low volatility regime to a high one, it often precedes explosive movement. We will see these examples in the next few minutes. This is your cue to shift from neutral or short vol strategies towards long volatility positions like long straddles or strangles or naked options. Conversely, when the market transitions from high IV to a lower regime, this volatility crash is a golden window for premium sellers. These are moments where options deflate rapidly and strategies that capitalize on time decay like iron condos, credit spread, naked straddles, they will shine. Now, beyond strategy selection, regime transitions also inform you how to size trades, where to set stops, and which instruments to use. IVRQ provides these signals with clarity, allowing traders to act ahead of the curve, not behind it. The key is watching not just the current regime, but the slope and direction of change. So let's now come to the recap what we learned so far. The core principles of mastering implied volatility and how IVRQ sharpens your edge. First, always remember that IV is about the magnitude of expected movement, not direction. This insight is foundational if you are going to trade options. You are not trying to predict the future. You are preparing for the size of its possibilities. Secondly, IVRQ converts raw IV into interpretable market regimes, low, normal, and high, and adds slope-based color coding. These visual cues drastically reduce guesswork. You are no longer reacting to volatility. You are anticipating it. Finally, expiry day trading becomes strategic rather than stressful. Don't we all want that? Now, with IVRQ, you can identify when to fade the open, when to brace for a breakout, and when to let decay do its work. This tool gives structure to chaos and replaces guesswork with clarity. So it's not just to trade, but to trade intelligently. Now I have got a few examples out here. This is like 15th. Okay, this is Sensex expiry 15th July. What you see out here is in the morning, the first red circle which I have marked, that is basically it is starting a high IV regime, correct? So when a high IV regime starts, you do not sell a straddle. The next pane just below the IVRQ is basically your rolling straddle kind of price, 80 to 600 straddle or something. If you see that, it does not practically go down, it's almost flat because IV is continuously going up. And the third point, IV signaled a high IV regime in the morning, and after that the major move in Sensex came. Now look at where there's a blue circle appearing for the first time. That means IV has entered a normal regime and it has left the high regime. If we look at the IV slope, it is red, that is IV is coming down. So around 12:30 is the time where you should sell a straddle. If you see a straddle out there, if you look at the prices that day, it was around 200 rupees. And till around 2:30 it went down to 88 rupees. One side going down if you see the straddle chart, because this particular thing was in a low IV regime and a normal IV regime was going up. Okay. After 3 o'clock we will not forecast because IV tends to zero at expiry, and expiry days after 3 o'clock IV will continuously go down whatever is happening to the market in the near options. So don't try to analyze IV after 3 PM on expiry day. Brings us to the next screen. This is a Nifty chart of 8th July. What you will see out here is, from the morning, Nifty was trading in a range. Okay, so continuously it was trading in a range. It was kind of flat, up and down going on. IV regime, if you see, was falling. Now this particular place at 240, IV entered, started going up. IV started expanding. If you say IV is continuously expanding, if you see prices are flat. After that, this massive move came. So when IV started expanding, if you are short on straddles, this is the straddle chart, it was smartly going down, and almost at the lows you could have got out of your straddle and prepared for a trending move on the market, right? This is your second example. The third example is the 10th July. The reason I showed this is, see, from the morning IV is in a high regime, and if you see the straddle price above, it is not at all falling. It is almost at the same price. Now IV here goes into red, that is IV slope starts falling. So here if you sell a straddle in the next red box, from there the straddle from 90 rupees comes down to like 40 rupees in the next 2 hours. And in the morning it did not decay till 11:30, 9:15 till 11:30. So through IVRQ you can pick the timing on where to sell the straddle and where to stay away, because if straddle is not decaying, you don't need to be in the market, na? Because straddle can go rapidly one side. So IVRQ helps you in timing, and you will see the indicators in the next video that we will be using the straddle indicator. We will have a stop loss, we will have something like an aggressive sell and stuff, but this video is just for IVRQ. So these are the 3 examples. You will also see the straddle trend indicator. Now we have supporting tools for this, but IVRQ will become the heart of your option trading modeling. That is, if you are selling options, IVRQ will totally analyze the IV for you and give you the zones. So this is actually a course. It's a complete trading course if you are a serious options trader. It is designed for traders ready to elevate their game. Whether you are brand new or already trading options, this course will deliver a full blueprint to consistently how can you find out profitable setups without the need for constant adjustments. Now in the heart of the program is our proprietary IVRQ and the straddle trend indicator. It will help you to identify safe zones for selling and warning phases, ensuring you are always a step ahead. With real-time signals and stop loss visualization, you will gain both confidence and precision in your entries and exits. We emphasize data-driven strategy over emotional trades in this particular model. This slide will highlight how our tool and philosophy come together to help you manage risk and maximize opportunity. Now let's dive deeper into the features and the models next. What you will learn and modules. We start by mastering how to interpret our exclusive indicator signals and understand where the risk is imminent. Then we explore the strangle selling methodology, how to incorporate daily range projection, select optimal strike price, etc. These strategies give you a repeatable edge in a market known for its volatility. There are 7 specific modules within the course, different chapters to explain Greeks, gamma risk on expiry day and everything. So the course leaves nothing out. And most importantly, the whole course is based on no adjustment approach. That is, if your strategy is going wrong, there will be a specific data-driven stop loss, you will cut your trades. Because in my experience, traders, option sellers have lost more money in adjustments than on the naked trade itself. The school of thought which I follow is, if you are doing an adjustment to a selling trade, you are actually doing a new trade, whatever you do. So you better square off your original trade, take a 10-minute break, cool down, then do a new trade when the model suggests. See, previously people used to do adjustments because they did not have a data-driven idea on what was happening. It was kind of guess, kind of delta, kind of kitna strike shift karta hai vagera. But these indicators will tell you which trade to do and where to do, so that guesswork goes out of the market. So if you enroll in this course, you will immediately get access to this suite of powerful indicators. All the indicators course is valid for 1 year. So the straddle trend indicator, IVRQ, range predictor, everything comes together to provide a comprehensive and a professional trading edge. You will have 1 full year of unrestricted access to the course material and tools with a simple option to renew after 1 year. We enforce strict capital protection, so no adjustment, no margin calls. Your risk is predefined with every trade. Because if you're selling a straddle and you know the stop loss, you know this is the maximum you can lose. Your stop loss should be always in the system. We will show you how to put a stop loss in the system, whether through an algo or manually. Now getting started is simple. Once you join, submit your TradingView ID to access. Now one more point. After you see this video, in the link you will find a Google form on which you can take a demo of this course. We will be starting the demo today and proceed it for end of next week. You will take the demo first and see if it suits your trading style, if you are comfortable and if you can make money. 1.5 weeks is enough to understand that. Do a paper trade, do a single lot trade, do whatever. But understand whether you are comfortable with the course. Because in my experience, option selling is not suitable for all. If you are comfortable and you have made some money, only then think of subscribing. But be aware that option selling requires a higher capital allocation. So this is my earnest request. Take the demo, use this for 1.5 weeks, see whether the logic, system, everything suits you. Then go into thinking about buying this indicator. Okay. Now after people subscribe to this indicator, I will hold a option selling masterclass. Now this will be totally different from the recycled material which you have seen so far. It will be absolutely unique. It won't be सवेरे देखा 10 डेल्टा का बेच दिया, 50 डेल्टा का बेच दिया, 12 बजे 15 डेल्टा का, ऐसा कुछ नहीं है. It's totally mathematical and you have not seen this kind of quant based maths behind it. It will be boiled down into actionable insights. You will get strategy sheets, which day, on which instrument, how to trade, what are the strikes you should do, why you are doing it, where you should enter, where you should cut off, everything. We will go beyond generic theories and dive into real math that governs markets, making it accessible even if you do not have a quantitative finance PhD. You will learn how top desk quants view and manage risk, especially around weekly expiries. This masterclass will be structured for traders who are tired of guessing. You will discover how to decide option decay and timing like a pro and walk away with a bulletproof framework that eliminates complexity. So this system is built for Indian markets, especially for Nifty, Bank Nifty and Sensex expiries, to deliver consistently without adjustment or fluff. So if you are done with the noise and want a real edge, this is where precision will meet simplicity. It is designed for those ready to take full control of their options trading journey. What you will walk away with? This masterclass will not be theory. It will be actionable clarity. You will gain a robust, repeatable options playbook that will hold its ground across all IV regimes. You will learn how to trade low, high, normal, spike, everything. Whether the market is stable or chaotic, you will know exactly how to position. You don't have to understand complex Greek equations. We will make it, you will be using Greeks, but extremely simple. We'll break down delta, theta, vega into practical tools you will use with confidence. You will understand timing and instrument selection. We will help you lock in clarity on both. Now to use these tools, you will not need to spend a dime on specific option analytical tools or platforms. Everything will be on TradingView. All codes will be on TradingView. It will be given to you, shown how to use. You can use it on your charts and do extensive options analysis. So this isn't hoping your trade works. As of now, if you are hoping after selling a straddle, buying option, I hope this works. That hope will get out of your trade. It is about building that statistical edge and risk discipline only professionals use daily. With these tools, you will not react. You will stop reacting. You will anticipate and execute with precision. That's the end of it. As I said, in the description box, you will find the Google form. Kindly fill up that form. After you fill up that form, give up some time to give you the indicator access. Under your TradingView, there is something called under indicators, there is something called an invite on the scripts. The indicators will be given out there. Number one. Number two, after this video, there will be a second video on the full suite of indicators, how to do the setups, how to set up the indicator, the settings, and how to use the indicators in conjunction with each other. When the demo is running every day post market, I will share the analysis for the day, what you have learned, what you have seen on the indicators, and how you could have used them on the markets. So that over the next 1.5 weeks will make it very clear how to use this on the system. So if you're interested on the demo, and once again I repeat, you please take this demo. Do not subscribe to this course by jumping into it, because this is an advanced course. This is not for novices. So do take the demo, use it for the time given, see if you can make money, see if you are comfortable with the concepts, then think of subscribing. Now, if you have taken the demo and if you are thinking of subscribing after 1.5 weeks, there will be a discounted offer for people. So wait for that. But first, do see the demo, see my analysis every day and understand how this is working. Okay. Thank you for watching this webinar. I believe you have picked up some concepts. Even if you do not subscribe to this indicator, these concepts will shape how you look at volatility and option selling. Thank you for attending and listening to me for so long. Thank you.